Now let's take a look at the balance sheet in more detail. Here is a simplified balance sheet that contains the most commonly used accounts. One item to explore further is the separation of assets and liabilities into current and non-current items and different components of shareholders' equity. The balance sheet is separated into current and non-current sections on both the assets and liabilities side of the balance sheet. Current assets are those that are expected to be converted into cash in less than a year and include items like accounts receivable and inventory. Non-current assets are those expected to be held for greater than 1 year and include items typically such as property, plant, and equipment, as well as intangible assets. The same holds true for current liabilities. These are liabilities that will be paid in less than a year. Accounts payable is a good example of a current liability, whereas non-current liabilities are those that have repayment terms that are longer than 1 year. So for an example, that would be a loan repayable over a 5-year period. Also, finally, when we look at shareholders' equity, don't forget that the profits of the business, the net income, belongs to the shareholders. So two common accounts in shareholders' equity are the amount of common shares, but also the retained earnings. That's the net income that was not paid out in dividends, but is reinvested in the business. Okay, let's start exploring the financial statements of Starbucks. Now, I'm on page 47 of the PDF. The printed number on this page is 44, if you want to join me. I'm just going to talk high level through the balance sheet. Now, if you've taken our accounting fundamentals course, a lot of these items are already going to be familiar to you. And what we're going to do is focus on the ones that probably are less familiar. Things like deferred taxes. We'll talk about accumulated other comprehensive income. We'll talk about goodwill. We'll talk about investments. So we'll cover the things that weren't already covered, but let me look at a holistic view of this balance sheet to begin with. First of all, it's on page 47 of the PDF, as I said. You can see that the numbers, it's important to identify whether these are in thousands, millions, and so on, so that we put some context around that, because it might look like it's 3,551.5, but in reality, those are millions. So that's 3.5 billion roughly. So we're talking in the billions for the most part. Total assets is 29 billion, 29.445 billion, and so on. We can see our total, well, I'm going to just scroll up so you can see it. We can see our total current liabilities of roughly 9.34 billion, total liabilities of 37 billion. And then we have an unusual situation here. We're going to spend some time exploring these line items that we didn't cover in detail in the accounting fundamentals course. And you're going to see that instead of shareholders' equity, we have something called a total deficit. Now, we will talk through each of these line items later in this course, but for now, just notice that retained earnings is typically profits are plowed back in. Well, last year, we started with a retained deficit of over 8 billion. Now, we did make profits this year, and that's why the retained deficit is shrinking. So if we continue making profits, over time, we're going to get back to a positive retained earnings figure. Okay, so just as a small note, the other thing is that the balance sheet is only part of the story. You need to, at the very bottom here, can you see it says, see notes to consolidated financial statements. If we want more detail on inventories, on deferred taxes, on any item on here, we can find that in the notes, and we'll explore the notes in a later lesson. Okay, so that's all I wanted to cover for now. I'll see you over at the next lesson. Okay, we're going to explore now some asset categories on the balance sheet that we haven't covered in our accounting fundamentals course. So if you are rusty with things like inventory, prepaid expenses, cash, accounts receivable, and so on, please check out or review our accounting fundamentals course. They're covered in detail in that course. We're going to focus on the assets that we haven't spent a lot of time looking at in the accounting fundamentals course. The first is investments. Now, we can have a couple of types of investments. We can hold external investments, and we often will hold external investments for a couple of reasons. One is we have excess cash, and if it's sitting in a checking or current account, it's not earning a return. So we are going to invest it short term to earn some return before we deploy that. Now, we could be deploying that cash in the future, perhaps to make an acquisition of property, plant, and equipment, or possibly another business. So that's another reason why we might have investments, just holding us over until we need to deploy that cash and making sure we get a return. We can also have internal investments, and internal investments could be things like joint ventures or subsidiaries. And whether we hold these investments internally or externally, we also need to let our readers know whether they're short-term, which means we don't expect the investment to be more than a year or it's less than a year, or whether that investment is long-term. We expect to hold this for more than a year. Let's quickly look at the balance sheet of Starbucks. So here's the top of the balance sheet, just total assets. And I'm just going to zone in on the two investments. We can see short-term investments of $401.5 million, but we also have some long-term, non-current investments, which were equity investments of $439.9 million. Now, if you want to understand equity investments in more detail, those are investments in other companies where Starbucks has a significant shareholding but doesn't control the company. And that's deemed to be if Starbucks owns between 20% and 50% of another company, it accounts for these investments as equity method investments. And if you want to know more about how to account for equity method investments, you must check out our Accounting for Business Combinations and Equity Investments course. So there we see investments in two places. Now let's turn to deferred taxes. So here we see on Starbucks' balance sheet under non-current assets, a deferred income tax line item of $1,769.8 billion. So what are deferred taxes? Well, deferred taxes can be a non-current asset or a non-current liability. The easiest way to explain them is related to tax rules versus accounting rules. Now, when a company prepares an income tax return, they have to use tax rules, and these are not always the same as accounting rules. If a deduction is never allowed for tax purposes, then we say that there's a permanent difference between the accounting rules and the tax rules, or accountable income and taxable income. And that's the end of the story. We don't do anything around deferred taxes if something is never allowed for tax purposes. However, if the deduction will be allowed in the future, then we say this is a timing difference. And therefore, we have to do something called deferred tax accounting, and a deferred tax liability or asset will be recorded. One good example of this and where it happens is when you depreciate or amortize a piece of equipment. For accounting reasons, you may want to just use straight line methods. However, for tax purposes, let's say an accelerated method is used. Therefore, the amount of taxes will be different until the equipment is fully depreciated. So it's a timing difference. And I'll do a demo with you to make this come alive. The difference between accounting income and taxable income is the basis for deferred income taxes, also sometimes referred to as future income taxes, and we record it on the balance sheet. Now, if there is less tax payable in the future, that's going to be a deferred tax asset. And conversely, if there will be more tax payable in the future, it's a deferred tax liability. Let's look at a real example to make this come alive. Okay, hopefully you've downloaded the deferred tax example template and you can work through it with me. I'm on the cover page right now, but let's get right into it. I'm going to go let me get into Excel. Control page down. And here I have the fact pattern. So these are in thousands. So I could quote things in thousands. I'm going to quote them just as they are. So for example, it says an asset worth 300. Well, that's 300,000, but I'm just going to say 300 for simplicity. The asset is depreciated on a straight line basis for GAAP purposes and double declining method for tax purposes, and the residual value is 0. So what we're really saying for accounting or the GAAP books is that we're going to take 100 and expense it each year. So after the first year, the asset will depreciate by 100. Therefore, the asset on the balance sheet will be 200 and so on. At the end of 3 years, the asset will be written down to 0. So I'm going to just sum these up and do the calculations. I'm going to do one column and then copy across using fill right. I'm going to go C16, I'm going to put the dollar signs by hitting F4 because I want to lock that reference. I'm going to multiply it by the row above, E15. And then I'm just going to, I'm going to put a negative sign in front of that. Another thing you can do if you, instead of the negative sign, is multiply by -1. One reason some financial model builders do that is it's more easy to see the negative number. However you want to do it, but both are acceptable. Then I'm going to do fill right, Control R. So our net income is constant across the period. Why? Because our revenues and COGS are stable and we're depreciating the asset in a straight line way. Hence, our net income should be stable and predictable. Now let's scroll down and say, okay, let's do our net income for tax purposes. And in this jurisdiction, we're allowed to write off 200 against our taxes in the first year and the remaining 100 in the second year. So it's going to be written off in 2 years rather than 3. So we're going to do the same thing. We're going to add it up. We're going to do the tax. I'm going to hit C25 and then put dollar signs with the F4 function, and then I'm going to multiply it by the row above. Whoop, forgot to put it multiply again. -1. Alt equals, copy across. Now you can see that our taxable net income, or net income, from a tax perspective is different each year. Now, one way to think about it, I'm going to scroll up. I know it's a bit large, but I think you can see both here, is we said we were taxed at 140, but we only had to pay 120. So we actually owe the tax authorities another 20 in the future. So we're going to have a deferred tax liability. So let's actually do that. So we're saying we owe, I'm going to just go take row E16, and I'm going to subtract row E25. I'm going to copy that across. You can see the function on the far left. I use the function equals formula text, so you can see what the formula is in that cell. And what we're saying with the negative number is the negative number is a liability. So we owe a future tax liability of 20, and that's because we only paid 120 when technically we should have paid 140. However, can you see what happens in the last year? It reverses. This is what we mean by a timing difference. In year 3, we paid 160, which is more than what we said in our GAAP records. We said the tax was 140. We paid 160. That's extra 20 is actually paying that tax liability that we, or deferred tax liability that we incurred in the first year. Now, as a sanity check, I like to do a check. And the check is basically, you should be able to identify the difference. So I'm going to go, if I take the depreciation allowed for tax and I minus the depreciation that we're doing, so it's netted off, and I multiply it by the tax rate, I'm going to hit F4 to lock those down. I should be able to match these numbers. Now, I did C25. You could have done C16, which is where the real input is there. Okay, so we have a deferred tax liability. That timing difference reverses out. Remember, a timing difference is a tax difference that reverses. That's where deferred tax gets involved. Now, let's just do a couple of quick checks. I'm going to scroll up. So here's another way to arrive at net income on the GAAP books. And this is what you'll often see. You'll see on the income statement 2 line items for tax, current taxes and deferred taxes. Well, what do we mean? Well, earnings before tax, we know is 700. We know what our current taxes are. Our current taxes are, and I'm going to, what we actually paid, which is the 120. But we also owe deferred taxes of 20. See, those two together are giving us, I'll scroll back up, our 140, which means we will get net income of 560. Let's just make sure that works. Alt equals, and then we'll copy that across with fill right. It should say 560 in row 36. Good, we've got it right. And that's often how it will be disclosed, again, on the income statement. And then when we think about the cash flow statement, we just need to think about a couple of things. We're going to do 2 ways to get to cash from operations. We can start with net income. And here we have net income. We're going to add back our accounting depreciation. So I'm going to put a minus sign there. I'm going to copy it across. And I'm going to add back the deferred taxes. So I'm going to put a minus sign, and I'm going to just capture the deferred taxes in that calculation. And what do I get? I should get 680. We have 660, and we have 640. Okay, so far so good. That's our cash from operations. Now we should be able to get the exact same number using the tax books, because we're talking about cash is king. So according to the tax books, our net income, I need to go to row 26. We're going to add back the depreciation, but this time it's the tax depreciation. And we should get the same number. That's our sanity check. Looks good so far. Let's copy it across, Control R, and they match. So I'm hoping this example helped clarify what deferred taxes are and why they occur. And then we'll see it in several places. We'll see it on the balance sheet, we'll see it on the income statement, and we'll see it on the cash flow statement. Okay, see you in the next lesson.